Hey guys, welcome back to 90 Seconds with Chris. Today's video is going to be on security. A security is simply anything that holds some kind of monetary or financial value and can be negotiated or exchanged for something of equal financial value. Stocks and bonds are examples of securities. For instance, in the equity world, stock is a security, and in the debt world, bond is a security. However, there exist some hybrid types of securities that combine aspects of equity securities and debt securities. This means that securities can be broadly classified into two types: equity securities and debt securities. Equity securities pretty much represents ownership in a company, typically held by company shareholders in form of stocks or shares. However, these shareholders are usually not entitled to frequent payment like interest. However, some companies have a policy where they pay out dividends quarterly or yearly to shareholders. However, this dividend can also be cancelled, taken away, or reduced at any time, strictly based on the company's decision. Although shareholders are typically not paid interest, they do have the power and the right to vote and to make certain decisions in the company. This is the pro of being a shareholder in a company. Debt securities, on the other hand, represent borrowed money that must be repaid back based on the loan amount, the interest rate, and the maturity date or the date of renewal. Such securities include bank loans, bonds, certificates of deposit or CDs, but however, they entitle the holder to some form of frequent payments such as interest, yearly or monthly interest. Think of interest as the rent you pay to borrow money. Anyways, back to my bakery example, where I had to raise $10,000 for startup costs, but I only had $2,000 of my money to put down. So I raised $4,000 through debt securities by selling bonds to bondholders at a face value of $1,000 per note, 10-year maturity date, and 10% interest rate. I also raised the remaining $4,000 by selling stock, which is an equity security, to shareholders at $1,000 per share. In this case, the bondholders are entitled to their 10% payment yearly based on the interest negotiated by the bond contract. And after 10 years on the maturity date, the full principal amount is going to be paid back to the bondholders. That's it for the video, guys. See you in the next one.